Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello, everyone. Welcome to today's Top Stock Picks. I'm Jeremy Mullen, and Ben Rains will follow me. But first, we will be looking at Deckers Outdoor. This stock is a Zacks ranked number one strong buy with ticker symbol DECK. This is a footwear and apparel company recognized for its premium lifestyle and performance brands. The company designs, manufactures, and sells shoes, sandals, and boots, emphasizing comfort and innovation. Now, the stock has fallen 40% since their last earnings report just a month ago. And this drop looks like a great opportunity to enter the stock. So today we want to look at the earnings, analyst estimates, the chart, and go over why this stock is so oversold. So let's look at the screen here. First, we have the profile page for Deckers. As you can see, the Zacks ranked number one strong buy. Looking at the style scores, we have A in growth, C in momentum, B VGM score, but D value. So value investors are going to shy away from this name because we do have a high PE. If you come down here and look at this 24 PE for a shoe company, some tech companies get the 24 PE, but not a shoe company necessarily. And this was much higher, right? So the stock has been cut pretty drastically. So that PE has been cut as well. We have a market cap of $21 billion now after the recent sell-off. A little bit more about Deckers. You might have heard of some of their well-known brands. We're talking about UGG, Hoka, and Teva. So these are some brands that do very well for the company. Deckers distributes its products globally, and this is through a mix of domestic and international retailers, distributors, and direct-to-consumer channels. These include e-commerce platforms and company-owned retail stores. So let's look at the earnings estimates, or let's look at the earnings first before we look at the estimates. This is a chart of all their beats going all the way back to 2020. As you can see, they beat almost every time, just one little hiccup back here. And since COVID, the stock has just been on a tear. So why the big move lower? Well, we have a 15% EPS beat versus a lot of much larger beats in quarters prior. So investors, fairly enough, knocked the stock down here. So it's been closer at this quarter. In addition to the 15% EPS beat, they exceeded the revenue estimates. They raised full year guidance for fiscal year 25 to $5.75 to $5.80 in that range, above the $5.62 consensus. UGG strength was prominent in the quarter. That's 16% year over year growth, driven by strong holiday sales and international demand. And Hoka sales surged 23.7% year over year. So pretty strong performance from Hoka. Now, this stock dip that you see on the chart, this is an opportunity. Shares traded lower due to a slightly soft revenue guidance. This was $4.9 billion versus the $4.93 billion expected. And also, we have some margin concerns and potential tariff concerns, which we will talk about in a little bit. But the core business does remain strong. And you're starting to see some analysts take down estimates for this current quarter because of the revenue guide. This is the estimates page where we can kind of see what analysts are doing, right? And we're go from a 71 cents to 56 cents. That's kind of concerning, right? And we can see the estimate revisions are in agreement. However, if you look at the next quarter, things kind of steady out. We have analysts kind of mixed on what they want to do. But longer term, we see a resumption of this earnings trend, which, the company, which you've seen all the way from 2020, the company is performed quarter after quarter. And with this, some analysts are still really bullish. We have a Citigroup raising Deckers after earnings from neutral to a buy. Their price target is $215. UBS went to a buy, or they were at a buy, and they kept their buy rating, and they went from a 267 target to a 284 target. Now, these price targets give us a range of 50 to 100% above the current trading levels. So clearly, these analysts see some meat on the bone going forward, despite this recent quarter. Let's talk about tariff risk really quick. Deckers manufactures a portion of its footwear in China. This makes it, of course, vulnerable to U.S.-China tariffs. These higher tariffs could increase production costs, potentially squeezing the margins, hence that margin concern. The company has been moving some production to Vietnam to reduce that risk. And if the tariffs do come, Deckers can always adjust their pricing strategy and pass these costs on to customers, but this could impact demand. So we got to watch all this stuff if the tariffs continue to stick around or increase. This is obviously a risk. Okay, let's look in the chart and see where the stock might be going. This chart goes all the way back to 2010, and you can see just a nice steady grind higher. And then it was hitting highs as COVID hit. And this little blip on the radar is COVID, right? I mean, it looks so small compared to where we are now. The stock has really taken off. And this is one of the more drastic moves that we've ever seen in this stock outside of the COVID move. So, if you just go back to every sell-off, it's been an opportunity. And that's what we're looking at here. Zooming in, one of the things I like to do, and if you guys follow me at Counterstrike, we always look at these Fibonacci retracements. So naturally, I've drawn some Fibonacci retracements looking for where this stock might go. I did have one from the earnings breakout that was around the 200-day moving average, and that cut through really quickly. So looking at this macro one, so multi-year fib, we have lows to highs coming down into this buy zone. And I think this is where, if you're interested in the stock, you really have to be aggressive over the next 10 points. This would be halfway back. And if we have a larger market sell-off, maybe tariffs come on, maybe we get down here, but you could miss this opportunity if you wait. Let's zoom in even more. Oh, before we do that, long-term targets, we're looking up here. And this aligns with that UBS price target, right? So this would be your long-term target. How do we get this position on for that long-term opportunity? Well, I think we're looking at this previous support back in last August. We're right in here. So you want to start a starter position, perhaps nibble in here. If it comes down that halfway back, you got to be buying more. And what I think you could do is trade around a core position as it comes at the moving averages. You short-term traders, really some nice opportunity for relief bounces in these moving averages. So I think you really need to enter here if you're interested in Deckers and trade around that for that these moving averages, these fibs, and then try to realize that long-term potential with at least your starter position, perhaps. So that's it for the chart. Bottom line is, while Deckers remains on track for its 5th consecutive year of mid-teens revenue growth, the market is reacting to these short-term headwinds. This creates opportunity for us. With premium brand positioning and strong direct-to-consumer momentum and a disciplined pricing strategy, Deckers is well-positioned for continued long-term success. So let's keep an eye on this name. Okay, that's it for Deckers, DECK. Here is Ben with his pick.
Thanks, Jeremy. Ben Rains here for Top Stock Picks. Today I'm looking at Garmin, which trades in the ticker GRMN. The GPS giant has outclimbed the tech sector for the past decade and past year. It's up 65% in the last 12 months after a massive spike after its Q3 results in October. The company also posted another big beat race quarter on February 19th. Garmin has crushed our earnings estimates recently, and its outlook continues to improve. The company grew its revenue by 20% in 2024, posting record sales across all of its segments in 32% earnings growth. The company also announced plans to raise its dividend payout by 20%, so that's really impressive. Overall, its diverse business includes fitness, outdoor, aviation, marine, and auto OEM. Though most people probably know the company for helping kind of kick off the consumer-facing GPS movement over 30 years ago with its in-car navigation systems, kind of helping it become a household name. Others might know it more for its fitness wearables and smartwatches that have grown in popularity despite challenges for Apple and others. But on top of that, the Switzerland headquartered firm is an innovator across aviation and marine. So it makes sonar, radars, autopilot systems, and other other cutting-edge tech for boats of all shapes and sizes. Meanwhile, its aviation business spans general, business, government, and defense, helicopters, and experimental aircraft, with offerings that include flight decks and displays, autopilot, navigation, radios, and much more. So it's really beyond a consumer business. It has an advanced radar business as well. So it's a really impressive tech company. So let's kind of dive into a little bit more of its growth outlook and other technical things as well, including valuation. All right, so now we are on our Zacks.com ticker page for Garmin. We can see that it has a Zacks rank number 1 strong buy at the moment, and that's due to its impressive earnings growth outlook. It's an upward earnings revision, so we can check that out here. This is its snapshot page. So we can see that its earnings revisions have kind of gone straight up, starting at the early part of 2024 for 2024, 2025, and 2026. So we can see it's up for the current quarter, so Q1 of 2025, its estimate's up 12% since its release a few weeks ago, including 4% improvement for 2025 and nearly 6% improvement for 2026. So that helps it land that Zacks ranked number one strong buy. Now we'll go ahead and take a look at its outlook for earnings and revenue growth. So we're calling for 10% revenue growth this year to get up to about 6.9 billion. Another 5% growth next year on top of that 20% growth it did in 2024. And then on the bottom line, we're calling for about 8% adjusted earnings growth and another 4% growth next year on top of that big 32% growth in 2024. And we can see that its most accurate estimates are also coming in well above consensus, which is a good sign and also helping it land that Zacks ranked number one strong buy. We can see that its most accurate estimate for 2026 is 6% above consensus, which is impressive. And it's topped our estimates by an average of 29% in the trailing 4 quarters. All right, so now we're over on our ZRS system, and we can see that Garmin stock is up around 900% versus Tech's 750% over the last 20 years. And if we go to the last 10, as I mentioned off the top, we can see Garmin's up 364% versus Tech's roughly 300%, driven by some recent positivity. So if we go over the last year, the stock is up 65%. We saw this huge spike after its earnings beat at the end of October, and it beat, as I said, last week or on February 19th as well. So that's that spike there. And then if we go to its technical chart, we can take a look at how it's trading against some of its moving averages. This is over the last decade. We can see that it found support near that 50-week moving average, and it's trading right near all-time highs. So let's go to the last year. We can see that it's kind of found chopping around support recently at the 50-day moving average while trading at some roughly neutral RSI levels. So that's a good sign that the stock has cooled off, even though it's up 65% over the last year. So it's going to try to maybe get back to that recent spike up to all-time highs, but it's really not super overheated, which is a good sign for Garmin. Then we can go to some valuation levels. It's really not a value stock, but no one would expect it to be based on its growth. So we can see it's trading at 28.4 times forward 12 earnings versus Tech's 25.2. And a lot of that recent spike down is all that selling, which has not impacted Garmin. The Garmin staying above the fray is actually a good sign. It's trading right near its all-time highs, even as a lot of these growth tech names have tanked recently. So we can see over the last 10 years, it's trading below its all-time highs over that stretch for about 30.1 times forward earnings. So it could cool down a little bit, and we could see that valuation possibly come back maybe towards the broader tech sector, but overall its earnings growth outlook is impressive, and it's certainly a stock to keep in mind. On top of all that, Garmin has a really impressive balance sheet. So it has about 2.5 billion in cash and equivalents, 9.6 billion, so nearly $10 billion in total assets, versus just $1.8 billion in liabilities with zero debt. So this is helping support its buybacks and its dividend plan. As I said off the top, expected to raise its dividend by 20% in 2025. Daniel remains a top player in consumer-facing segments, despite mounting competition, because it has really impressive kind of best-in-class offerings. Also a standout in aviation and marine with an ability to grow via offerings in-house and through strategic acquisitions down the line. So certainly worth putting Garmin on your own radar. And that does it for me in this episode of Top Stock Picks. Please head over to zacks.com/promo for a look into some of our services, portfolios, and more.